Cece, welcome to the Orbit. It is Tuesday, May 7th. We are pretty deep into the trading day, but I wanted to catch up on some of the things we've been talking about on the Orbit the last few days. And that is a market that is seeing much lower volatility, IV, in the options premium side of things for the last few days as compared to where we were midweek last week. And then on top of that, what we've been talking about, is that a sign of a market getting loaded with option sellers and some gamma? And what that tends to do is put a little bit of a dampener on market moves. And so today we saw a little bit of a gap higher on the open into the green. And then the market tried to make another one of those slow creep runs up to about the 5,200 level. And within the last hour, it has found some sellers, and we're back down near unchanged. The SPX only up about 2 points as we're watching this chart right now. The expected move the rest of the day is just 0.2%. That is a 17 IV, which again is very low 0DTE IV. If we go to the 1 week chart and we look out over the next couple of days, for tomorrow, we've got 11 IV and under a 0.5% expected move, closer to 0.4%. Going out to Thursday and Friday, again, we're at about 11 IV. That is very low. That is as low as we've seen it in about a month or more. So for credit spread traders on 0DTE and short duration, again, you are selling very low IV, so you have to be very careful about how close you are to at the money. If you had done a trade yesterday to sell the move today, you probably would have been up around that 5,200 level if you were selling the credit call spread side, or if that was the upper side of an Iron Condor or something like that. So be very aware of that. You might want to wait to see some market moves first. This is an interesting scenario where if we did go into the red, does that find buyers just like that rally earlier in the day found sellers? And that would be a sign of a market with a lot of gamma in it, where the market goes down and there's buyers, the market goes up and there's sellers. As you can see on the 1 week chart, we had these gaps high. We had all that volatility last week. We had these gaps higher. And then this is when vol started to get crushed. Short duration vol started to get crushed. And you saw this slow creep higher. And that low IV, long gamma market conditions is the type of market conditions where you do see those slow creeps. So a lot of times for credit spread traders, the upside on those slow creeps in certain days, like yesterday was a great example. We saw that move higher and it just sort of kept going into the close. And, it was the potential to get kind of squeezed on your upper strikes. If that's the case today to the downside, do we finish with like a 15-point move to the downside into the red, even though it's not necessarily the start of a new trend or some selling, but it might be enough that, in this case, we're looking at an expected move down to the downside of 51.74. That is less than 10 points away. So that's what you sort of have to be aware of, especially in those last couple of hours of the trading day. Going out to the 1 month chart, of course, this is a interesting setup for those that are trading directionally, and this could be SPY, Qs, could be individual stocks. You get out into the middle of the week, this is that CPI number we were pointing out the last couple of days. It hits May 15th. Got a little bit higher IV there, and you can kind of see the expected move chart kind of bounce out there. So that's the next big macroeconomic data event that traders and investors will have their eye on. Before that, options are pricing very small moves. And for those positioning for debit spreads and directional, going out beyond that, see if you want to catch that CPI, if you think that's going to be a catalyst to the upside to take us back to new highs, or to the downside, meaning the inflation story hasn't really changed and we might go back into a little bit of a bearish cycle like we saw a couple of weeks ago. That going out beyond that CPI makes a lot of sense because it is still low volatility. It's just higher in comparison to other even lower volatility around that. Let's look at the Iron Condor levels. We'll go out and we'll change this to the 10th as an expiry. And we look at these levels And again, this is very low volatility, 51.40 to the downside, 52.20 to the upside. This is out till Friday's expiration. We got near 5,200 earlier today. So the first thing you could do is you could look at, taking this wider, getting that short call maybe up to, let's call it the 52.50 level. At that point, you're down to the 5,100. Take it a little wider. We're 5,100 to the downside, 52.60 to the upside. On a 1 month chart, you can see where that lines up with some of the recent levels. And again, you are basically a new high to the upside or matching those old highs, and to the downside, well short of some of the recent lows, even 4 or 5 trading days ago. So a reversal in the market lower from anywhere near here, or 5,200 was a temporary high, or if we get back to those prior highs, volatility would remain quite low in those conditions. If the market reversed and we went lower by a couple of percent from here, that's when you would see vol start to tick up. But until it breached those lows that we saw last week, where we were down near the 59 or 49.50 level, till you broke through there, you probably would not see super high IV or super high VIX. You would see that spike back above 20. It would probably take a new low, or at least a couple of really ugly days, to get the VIX back up above 20.